Why does Africa trade more with Europe, Asia, and North America than within itself? A continent of 1.4 billion people struggles to integrate its own markets. The answer is a layered system of frictions, and AfCFTA must work against deeply embedded structural barriers. Consider a bag of coffee from landlocked Mali. Instead of crossing to a neighbor, it travels to a port in Senegal, ships to Europe, then returns to a country right next to Mali. The route is long, circuitous, and expensive. This is the transport and infrastructure constraint. Colonial-era transport design still shapes today's flows. Rail networks across borders are limited, inland roads are weak, and port-to-hinterland logistics underdeveloped. Goods often transit through Europe or Asia before redistribution. Geography is African, but logistics remain externally oriented. Trade depends on information flows. Intra-African markets suffer weak price discovery, limited cross-border intelligence, fragmented digital platforms, and language discontinuities. Without reliable information diffusion, transaction costs stay high, even when tariffs fall. Infrastructure is more than roads and ports. It includes energy reliability, digital payments, customs interoperability, and cold chain logistics. Recent assessments highlight an infrastructure financing gap exceeding $100 billion annually. Without this backbone, trade agreements remain partially operational. Even where infrastructure exists, borders create constraints. Complex customs documentation, inconsistent inspections, checkpoint delays, informal payments, and overlapping jurisdiction. These non-tariff barriers often exceed tariff costs and reduce predictability in cross-border exchange. Africa's trade governance is structurally complex. Multiple regional economic communities overlap with inconsistent tariff schedules, divergent rules of origin, and conflicting enforcement. The result is policy incoherence rather than integration. A deeper layer comes from history. Colonial economies were built around extracting primary commodities along corridors to coastal ports, with limited interterritorial networks. Production remains externally oriented. Transport still follows export routes, and regional value chains stay underdeveloped. AfCFTA reduces tariff barriers, but it does not automatically resolve infrastructure gaps, logistics inefficiencies, administrative fragmentation, or information asymmetries. Its effect is conditional on implementation capacity at national and regional levels. Intra-African trade remains low because constraints reinforce each other. Weak infrastructure raises transport costs. High transport costs reduce market integration. Poor integration limits information flows. Weak information flows sustain fragmentation. Fragmented governance reinforces policy inconsistency. Breaking the cycle requires action on the ground. Construction workers building cross-border roads, farmers loading trucks efficiently, and border officials stamping documents quickly. Internal trade lines must glow stronger against the darkness. The persistence of low intra-African trade reflects a layered structure: transport deficits, infrastructure gaps, weak information, border frictions, overlapping regimes, and commodity path dependence. AfCFTA provides a framework, but the real question is whether physical, informational, and institutional conditions exist to make liberalization operational.